Hello there everyone, in today's video we're going to continue the series on interest relief on mortgages for buy-to-let landlords. So in the previous video I talked about the mechanism for claiming the tax relief on the tax return, how it was restricted depending on the composition of the taxpayer's income. Today we're going to talk more about first principles in terms of the amounts that can be claimed. So, the basic rule is this: if you take out financing, take out a loan, a mortgage, to be used wholly and exclusively for the purpose of your property rental business, then you can get this interest relief subject to the mechanisms of how it is actually given as relief. But that's the fundamental rule, that if the loan is used for the purpose of your buy-to-let property, you're going to get the interest relief. Now, the next rule is the interest relief can only be given on a loan as long as that loan does not exceed the market value of the property at the time it is let out for the very first time. Okay, so this is a simple example. Let's say you are an individual taxpayer, it's your first foray into the buy-to-let world, and you identify a property for $250,000. If your first buy-to-let property, you're going to own it as an individual, and you're going to put 50 grand down as a cash deposit, and you're going to borrow 200,000 from the bank. So what have I just said? I've said the rule is that the interest on that mortgage is fine as long as the mortgage doesn't exceed the market value of the property at the time it is first let out. So in that case, in this first instance, it's dead easy. Well, the mortgage isn't going to, you're not going to get more than the 100% mortgage. You're putting 50 grand down as cash, 200 grand down as mortgage. The market value at the acquisition, 250 grand. The guy lets it out straight away, so the mortgage is less than the market value. But let's just fast forward. And what a lot of landlords do is they refinance. So equity will accrue and grow in their buy-to-let property. So they'll release some equity, put that down as a deposit for the next property, gear up on the next property, and so on and so forth. So that over time there are multiple properties with multiple mortgages attached to each one. But the basic rule still applies, that the total borrowings have to be less than the market value of the property at the time they were first let out, not the current value. And it's all done on the aggregate. So what do I mean by that? Well, let me just show you an example, throw in some numbers. So let's assume Mr. X, his first buy-to-let property, the value when it was first let out, that's the crucial thing here, 175 grand. Now, its current value is 300,000. Okay, so it's going up in value, nice. What is the current borrowings? Because like I said, assume this is a few years into this guy's buy-to-let experience. He's got 3 properties, 3 mortgages. So where are we at with each of them? So this first one, market value 300 grand, market value when he bought it 175. He's got borrowings of 250,000. So what did I say? I say the interest relief is curtailed on borrowings up to the value when it was first let out. So assuming he only had this one property, straight away you'd say, well, he's only going to get tax relief on 175,000 of this current 255,000 mortgage, because the rule says you can only get it up to the value at the date it was first let out. But the rules also say you need to consider it in the aggregate, not just in isolation. So then we keep going. We have a look at the other 2 properties. Number 2, value when first let out, 325,000. Current value, 450,000. Current borrowings, 220,000. Okay. Then we look at the third one. Third buy-to-let property was valued at 250 grand when he first let it out. Current value 375,000. Current mortgage 260,000. So the rules let you look at this in the aggregate. So all we do is we say, look, the value of the properties when they were first let out in excess of the current borrowing, what is it? Well, for property number one, it's negative 75, which would mean in isolation, the rules have been busted. But like I said, you've got to follow it through and see what the end result is. So in property number two, which is this saving grace here, the current borrowings of 220 is 105,000 less than the value when it was first let out. Then for number three, it's negative 10. So even though properties number one and number three, the current debt is more than the value of the property when it was first let out, because of number two's borrowing being significantly lower in comparison, and the value on day one was a lot higher, overall, he's 20 grand up, as it were. So overall, the market value of all three properties on the day that they were first let, 750,000. Current value, 1,125,000. But that's really a bit of a red herring, because all we really care about is column one and column three. So the total borrowings today, 730,000. And because 730 is less than 750, he can get interest relief on the whole lot, on all of the borrowings, 730,000. You wouldn't say strike out 1 and 3 just to the level of day one. You can get it based on the sum of the whole portfolio. So I would suggest quite a lot of people don't actually appreciate that, but that is the rule, that you have this scenario where you only can get it up to the level of borrowings on day one, subject to looking at them all in aggregation. So you have to do this computation. If you've got multiple buy-to-let properties, to work out the interest relief that you can potentially get, then you'd have to work this out. So in this case, he can get potential interest relief on all of the 730,000 of borrowings. Then, of course, we've got to come on and say, well, right, how is that going to be relieved, subject to the test that we looked at before in terms of the 20% reducer and the composition of his other income. But the starting point is that potentially you could get relief on all of that. So just an overview there on what I would suggest is quite a not well known rule on buy-to-let interest relief. It's all about comparing the quantum of the borrowings on each property compared with the market value on the first day that property was let out, and then arranging a formulaic approach to tot up how that would work for all of the properties, and seeing what the bottom figure is and whether or not you could get relief or if it needs to be restricted. So, if you like this video, please do subscribe, and as always, I'll see you soon.